what you'll generally do is you'll look at and see like what's market right now for a typical Series A in your industry, and then kind of marking it down a little bit from there. So if, a Series A round, on average is coming in at about a $25 million pre-money valuation, which is, in ballpark. The last few years, valuations for Series A, I think, from my perspective, have been in that like $20 million to $50 million range, give or take. So, right now where things are a little more compressed, maybe it's $25 million. Maybe you knock it down a little bit and you say, I'll do a cap of $20 million, right? Something that gives me a little bit of, a cap in terms of like, if you just knock it out of the park and you raise it a $50 million valuation, I still get in at like a really low valuation on a comparative basis, but is pretty close if you came in at a $25 million valuation on your Series A, so that you still have, close alignment with those other equity holders. Because one thing that can like get a little bit out of hand is as you add more investors at different valuation levels, they're all going to have different incentives on when they want to exit the business, and what kind of decisions they're pushing for. Like, do we push to go public, or do we push to sell the business and get acquired, or how much we want to push on the growth pedal and burn cash or whatever it might be. So especially at the early stages, you want to have like good alignment with the other investors, and being out of whack too much on valuation can cause some issues there.